Okay, so have you heard that story about Sir Isaac Newton? You know, the genius who figured out gravity. Turns out, even he lost a fortune in the stock market.
Yeah, it's a classic case of letting emotions get the best of you.
It just goes to show that even the smartest people can fall prey to those classic investing blunders. And that's what makes today's deep dive so fascinating, right? We're cracking open The Intelligent Investor by Benjamin Graham.
And it's not just some dry textbook, by the way. Graham's strategies are all about avoiding those very pitfalls that tripped up even a mind like Newton's.
Exactly. So for our listeners who may not be familiar with him, let's rewind for a sec. Who was Benjamin Graham?
Well, imagine this. It's not some stuffy academic. Graham was a seasoned Wall Street investor. Decades of experience in the trenches. He learned the hard way how euphoria and panic can warp even the best intentions.
He really lived through it all, didn't he?
Oh, absolutely. And that's what makes his insights so valuable. He wasn't just theorizing. He built his success through meticulous research, really digging into the nitty-gritty of businesses.
Okay, so give us an example. What's one of his legendary moves that really exemplifies his approach?
Well, there's the story of Northern Pipeline. Graham dove into their financial reports, I'm talking obscure documents here, and realized the company was practically sitting on a gold mine. They had all these bonds just tucked away that were worth more than the entire stock price.
Whoa, so he made a killing by spotting this hidden value.
That's classic Graham. He wasn't chasing the latest fad. He was finding opportunity where others weren't even looking.
He practically invented value investing, as they call it now, right? But his book came out in 1949. That's, what, almost a century ago?
Yeah, it's incredible, isn't it?
So why is The Intelligent Investor still relevant? We're talking a time before the internet, before index funds, heck, before most of our listeners were even born.
And that's the beauty of it, right? The book has survived market crashes, tech bubbles, you name it. It's weathered every storm because Graham's principles are timeless.
So it's not some get-rich-quick scheme.
Not at all. He gives you a framework,
Yeah.
way of thinking about investing that's based on thorough analysis, really understanding what you're buying and minimizing risk.
It's about aiming for consistent returns over the long haul, not jumping on the next hot stock tip.
Exactly. And that's what we're hoping to equip you with today.
And that long-term perspective seems key, especially in today's market. It's so easy to get caught up in the hype. So let's break it down for everyone. When we say intelligent investing, what does that actually mean in practice?
It's about being a business owner,
Hmm.
not someone glued to a stock ticker, watching every up and down. Graham famously said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine, meaning you have to look past the daily noise and focus on a company's real worth.
Okay, hold on. Real worth. Unpack that a bit for us. We're not just talking about whatever the stock price is at this very second, right?
No, not at all. Intrinsic value is what Graham calls it. You got to pop open the hood and see what's really going on. Analyze the company's assets, its earnings. How strong is the management team? What's the competition like?
So you really need to understand the underlying business. It's not just about playing the stock market.
Exactly. And the more you understand, the less likely you are to make rash decisions based on fear or hype.
That actually makes me feel calmer already. But how do we even begin?
Well, Graham lays out some key elements in the book.
Hit us with them.
First off, like we've been saying, thorough analysis. You can't just skip that part. Then, you've got to be smart about protecting yourself from losses. And finally, and this one might surprise some people, you're aiming for adequate returns, not necessarily extraordinary ones.
Wait, what's wrong with shooting for the moon with our investments? Don't we all want those massive returns?
Of course we do. But Graham, he understood human nature. He knew that chasing those too-good-to-be-true opportunities—
Well, it usually leads to trouble.
exactly. It can make you impulsive, lead you to take unnecessary risks.
So it's like that old saying, if it sounds too good to be true.
It probably is. Graham would much rather see investors build a portfolio for the long haul, something that can weather the inevitable storms.
So he's saying it's smarter to aim for steady, consistent growth instead of trying to get rich quick.
Precisely. Now, to do that, you need to be able to spot the warning signs and understand when the market is leading you astray.
And that brings us back to our friend Sir Isaac Newton, right?
Oh yeah, he got burned pretty badly.
What happened?
So there was this thing called the South Sea Bubble happening back in the 18th century. Speculation was running wild. People were buying up shares of this company, the South Sea Company, even though its business model was pretty shaky,
It was the hot stock tip of the day.
basically. And Newton Well, he dabbled at first, made some decent profits, figured he was smarter than the average investor.
Oh, I know where this is going. Pride before the fall.
You got it.
Yeah.
He poured even more money in as prices kept going up. Then boom, the bubble burst.
And Newton lost his shirt.
He lost a fortune. It said he later lamented that he could calculate the motion of heavenly bodies, but not the madness of people.
Ouch. Talk about a hard lesson.
But it perfectly illustrates why Graham's philosophy is so essential. It's about protecting ourselves from those emotional reactions, the ones that can lead to disastrous decisions.
So how do we actually do that? Where do we even begin to apply these principles? I think we need to dive into that.
All right, so we've laid out some of these core principles of intelligent investing. Thorough analysis, protecting against losses, and aiming for those steady returns. But how do we actually put those into action? Where do we even begin?
Well, this is where Graham's insights get even more interesting, because it's not just about crunching numbers.
Oh,
It's about you, the investor,
what do you mean?
your temperament,
Yeah.
your emotions. Those play a huge role in your success.
It's like that old saying, right? Investing is as much about managing your emotions as it is about managing your money.
Exactly. And this ties directly into this whole debate about active versus passive investing.
Right. Which is better, index funds or picking individual stocks?
Hmm.
Well, Graham, he wasn't dogmatic about it. He said your approach, it should really depend on you. How much time and effort are you willing to put in?
So someone who loves digging into company reports, all those financial statements, they might thrive with that more active approach.
Right. But that's not for everyone.
Not all.
And for those who prefer a more hands-off approach, Graham's principles, they actually align really well with what we think of as passive investing today.
So index funds, even though they weren't around back then, they'd fit right in with his philosophy.
Absolutely. Diversification, minimizing risk, seeking those steady long-term returns, that's classic Graham.
Okay, so whether we go the active or passive route, there are some key takeaways from the intelligent investor that every investor needs to know, right?
Oh, absolutely. And I think we have to start with one of the most powerful metaphors in investing history.
Okay, hit me.
Mr. Market.
Mr. Market.
Graham, he personifies the market. Imagine this fickle, emotional character who's always knocking at your door.
Okay, I'm picturing it.
And every day, he's offering to buy or sell you stocks.
So what's the catch?
Mr. Market, he's prone to some serious mood swings.
Oh, I know the type.
Some days he's euphoric, irrationally exuberant, willing to pay top dollar for everything.
It's dangerous.
And then other days, he's a downer, totally pessimistic, practically begging you to sell your shares for pennies on the dollar.
It's like those friends we all have. Up 1 minute, down the next.
Exactly. So how do you tell when Mr. Market is being irrational?
Yeah, that's the million-dollar question, isn't it?
That's where the hard work comes in. Remember when we talked about a company's intrinsic value?
Yeah, they're real worse.
Right. So let's say you've done your research, you understand the company, its earnings potential. Now, if Mr. Market comes knocking, offering you a price that's way lower than what you know it's worth,
That's your chance to buy low.
you got it. Take advantage of his bad mood.
And on the flip side, if he's caught up in some frenzy, driving prices through the roof for a company that's not really worth it.
That's your signal to stay put. Don't get swept up in his excitement.
Don't let his emotions dictate your moves. I like it.
Exactly.
Okay, so we've got Mr. Market figured out. What other gems did Graham give us?
Let's talk about margin of safety. It's a big one.
Okay, what's that?
It's the idea that you should always buy assets for less than what you think they're really worth.
So like haggling for a car? You're not going to pay sticker price.
Exactly. You want some wiggle room in case you find out later there's something wrong with it.
Yeah.
That discount, that's your margin of safety.
So if my research tells me a company is worth $100 a share, I'm not buying unless it drops to, say, $80.
Now you're thinking. That buffer, it protects you against surprises, things you couldn't have predicted.
This is making a lot of sense.
It's about managing risk.
Now, I know Graham, he wasn't a fan of those growth stocks, the ones that are all about future potential, not so much about today's profits. Why was he so skeptical? So we were talking about Graham and those growth stocks, the ones all about potential, not so much about actual profits right now.
Yeah, you'd seen too many people get burned,
Yeah.
paying sky-high prices for companies that hadn't really proven themselves.
It's like betting on a rookie who might become a star athlete, but there's no guarantee.
Exactly.
Yeah.
Might have all the talent in the world, but can they deliver consistently? That's the question.
And I bet Graham would have some thoughts about some of the tech valuations we've seen lately.
Well, I'm sure he'd have a field day.
But here's the thing. Wasn't his whole philosophy about finding companies that were undervalued?
But right, finding those hidden gems.
Exactly. But how does that even work in today's world? So much of a company's worth is intangible, right? Like, how do you put a price tag on a brand name? Or algorithms? You can't just find that on a balance sheet.
You've hit on a really crucial point. This is where things get interesting. Graham, he was focused on tangible assets, a proven track record. That's harder to do with companies built on, like you said, intellectual property, things like that.
So is his approach obsolete? Is that what you're saying?
Not necessarily. It's a question every investor has to grapple with, for sure.
So where do we draw the line? How do we take Graham's wisdom and apply it to today's market?
Well, while Graham might not have had the exact playbook for valuing, say, Amazon or Tesla,
Right, those weren't around back then.
his core principles, they still hold up. That emphasis on research, on really digging into a company's competitive advantage,
Understanding the playing field.
and maybe most importantly, his warnings about speculation, about getting caught up in the hype, those are timeless.
So it's about adapting, evolving our thinking, but not throwing out the fundamentals.
Exactly. It's like Graham gives us this really solid foundation to build on.
But we have to take those tools, those principles, and use them to navigate the complexities of the market today.
Couldn't have said it better myself.
This has been fantastic. Hopefully everyone listening is walking away with a better sense of what it really means to be an intelligent investor.
And remember, it's not just about beating the market.
It's about making smart decisions for your financial goals.
Exactly. Having a strategy you can stick with.
This has been another great deep dive. Until next time, everybody.